Hi, this is Terry, and we're going to do Chapter 13, but before we do, we're going to start out with some very basics. And the first basic is that the accounting equation, which is this assets equals liabilities plus owner's equity, is that's the accounting equation. So assets are resources used to generate net income in the future. So that's the first thing to remember. That's all the assets or all the resources that a company owns. The right side, excuse me, of the equation is then who owns those resources. And there's only two people that can own them. We can own them, which are called owner's equity, or other people can own them, which are called liabilities. In other words, another name for that is called debt. So, of all the assets of a business, two people can own them. We can own them, or other people can own them. And that equation must always be in balance. After the first chapter, then, you moved on to Chapter 2 in financial accounting, where you learned debits and credits. And that simply means left and right. You can't say increase and decrease because when you debit or the left side of an asset, it increases, but the left side of a liability is a decrease. So the left side of an asset increases, but the left side of a liability decreases. So you just had to memorize this T accounts, which represents the ledger, right? Represents the ledger. Where do we go from here? The accounts that affect owner's equity by operating, which makes owner's equity go up or down, is revenues make owner's equity go up because you operate your business and revenues provide equity, provide more money. Expenses make it go down, and dividends, or if you're a sole proprietor, that's called drawings, makes owner's equity go down. All right? Then the whole purpose of financial accounting, and let's blow this up a little bigger, then is to produce financial statements to the outside world. So the most simplest is the income statement. And this would be for a service industry, because all you're doing is providing a service. You're going to record all your revenues, you're going to subtract all your expenses, and then you're going to get net income before taxes. Then you subtract your taxes to get your final net income. So because you're just showing revenues minus expenses, then you know you're in a service industry. If you were going to do merchandising, so I'm going to flip to another tab, then you're going to use, instead of revenues, you're going to say sales. So let me blow this up. Then you're going to say sales, and now you're going to subdivide those expenses into three categories. So instead of saying revenues minus expenses, revenues will now be called sales, and then your expenses will be in three categories. The first one is cost of goods sold. The second one is, whoops, my cursor's too low, operating expenses. And then the third one is taxes. For cost of goods sold, then because we're in merchandising, then you now have inventory. And when you're under a periodic system, then you're going to calculate what your cost of goods sold is. So you're going to say your beginning inventory plus your purchases, and you'll calculate your net purchases, That will give you all your goods available for sale. So that will give you everything you possibly could sell. You'll subtract out how much inventory you have at the end of the period. So the difference between your beginning inventory plus everything you purchased, your net purchases, right, minus your ending inventory, then that must be what was sold or stolen. And theft is the period cost. In a perpetual system, you're not going to calculate the cost of goods sold. You're not going to have purchases, because in a perpetual system, every time you make a transaction, you're going to record that. So as soon as you see purchases, you know you're under a periodic system. Your operating expenses then break down into selling and general and administrative. So this is an abbreviated version, because underneath the selling expenses, then you would have wage expense, and you'd have depreciation expense, and you'd have I don't know, entertainment expense or repair expense, you know, all your different expenses, because the selling expenses is a category. Same with general and administrative. It's a category of expenses. So again, this income statement here, as soon as you see sales and cost of goods sold, you know that you are merchandising, where if we go back to the previous tab and you see revenue minus expenses, then you're going to be working with the service industry. So that'll be something like preparing your taxes or mowing yards, those kind of issues. Something where you're not carrying inventory. So that's the first of your 4 financial statements. The second financial statement is the statement of retained earnings. So you're going to have your beginning retained earnings, right? How much earnings have you retained in your company? You'll add to that how much money did you make in the current year. You'll subtract of the money you made in the current year, how much did you distribute? And for a corporation, that would be called dividends. In a sole proprietor, that would be called drawing. And then the difference, what you made minus what you distributed, would be the new updated balance in the retained earnings. Once you have that new updated number, which is dependent upon having this net income figure, that net income figure has to come in and feed into this number here. Now that new retained earnings balance has to feed in down here in the balance sheet. So you'll notice that the balance sheet is nothing more than the accounting equation. It's assets on the left, liabilities, and owner's equity on the right. When you see stockholders' equity, you know it's a corporation. Owner's equity is a more generic term. So owner's equity could be a sole proprietor, it could be a partnership, it could be a corporation. As soon as you say stockholders' equity, then you know it's a corporation. So assets are going to be cash, accounts receivable, supplies. You're going to have prepaid rent, prepaid insurance. You're going to have land, building, equipment. You're going to have investments. You're going to have intangibles like copyrights, patents. But this particular balance sheet example is from Chapter 1 of Financial Accounting. So it's very, very limited. It's just as a reminder. The liabilities, right? The short term will be at the top. The long term will be at the bottom. And again, in this example, there's just some short term accounts payable, income tax payable, salaries payable. If this was a bigger example, then you'd see something like long term would be mortgage payable or bonds payable. The stockholders' equity is going to have common stock. If it was a bigger example, you'd see the PIK account or preferred stock. And then you have retained earnings. So you've got assets on the left, total assets 27.3. The liabilities plus the total stockholders' equity added together, the 27.3 has to equal the 27.3. And then the fourth statement is the statement of cash flows. And the statement of cash flows, and let me make this a little smaller. The statement of cash flows is divided up into three areas: cash from operating activities, cash from investing, and cash from financing. And what it does is proves that your cash at the beginning of the year, in this example, started at $25,000 and ended at $82,400. So the difference between those numbers, the change from 25 to 82,400, was explained. This $57,400 change from 25 to 82 was from these three numbers: the 63,300, the minus 12,900, and the positive 7,000. So cash increased from operating your business by 63,300. Investing used cash, in other words, cash went down 12,900, but financing brought in cash flow of 7,000. So the statement of cash flows does nothing more than take your other three statements, the income statement, the statement of owner's equity, and the balance sheet, and restates it from a cash flow perspective. You can have a yacht, you can have a Lamborghini, you can have a penthouse, but not have cash in your pocket. And that's the issue. So many businesses have a lot of resources. People may owe them a lot of money, have a huge accounts receivable. They may have a lot of inventory, but they may not have a lot of cash. So what this statement does is says, this is how well they did from a cash basis, right? So it just restates how well the business looks from a cash perspective instead of an accrual perspective. So that's just a very, very quick reminder of the statements, the accounting equation, and debits and credits. If you just don't remember a whole lot of this, then you can go to terrytube.net. If I can spell here. I didn't put, honest to gosh, my fingers are just not working. terrytube.net. There we go. And then go down here to financial accounting videos. And then here are all my financial accounting videos. You can go back through and watch any of these videos. The YouTube will be have closed captioning and will be ADA compliant. The HTML will be web pages. So if you're on a Mac, that might be your best option. Either one of these. If you want to download and take this with you, because you're going to put it on your phone, or you're going to put it on iPad or something like that, as long as you can play MP4s, then you can delete them later. So these files are all available to you. You can watch them. You can refresh your memory on all of these if you want to. They're all only about 15 minutes long. They're just the bare bones of each chapter that I use in my financial accounting class as a preview of the chapters. So when the students read the chapters, or supposedly read the chapters, it gives them a frame of mind of what they're reading, so when they do read it, it hopefully makes more sense to them. So I'm going to switch gears, and I'll continue on with Chapter 13 now. The next little piece before Chapter 13 that I guess I should throw in here is the General Journal. And the General Journal is the book of original entry, so every transaction is recorded with a debit and a credit, or a minimum of 1 debit and 1 credit. Could be 100 debits and 100 credits, but a minimum of 1. So you record the debit, you indent, and then record the credit. Debits are always first. You put in the date, the debit, and the credit, and then you can put in a memo, anything that you want to write in there. You use the debit column, the credit column. The post reference then is to which count, ledger account, are you going to transpose these numbers to. The page number is up at the top. And so you're going to record every economic event chronologically. So you record all these events as they happen, and then what you'll do is you will then post them to the ledger. So this ledger account then, for every account that you create, so this one happens to be cash. So back up here where we sold shares of stock, so we got cash. Then the second transaction, we paid rent, so there's a credit to cash. We paid some insurance, so there's a credit to cash. We bought some equipment, credit to cash. So a debit to a cash for the investment and 3 credits. Then in the ledger account for cash, then you'd see the debit and those 3 credits. And then you see another set of columns that keeps a running balance. So at any point in time, we could say the balance on the end of May 1st in the cash account is $4,095. So it's the ledger account that gives us that running balance, and it's this debit credit with this kind of up down. This is the T account. So instead of kind of trying to draw all these lines, that's what the previous lecture accounts here. That's what these T accounts are here. We're showing cash here with the debit side and the credit account. That's what we're, the shortcut, that's what we're trying to represent here. So this bar going across and down, that's our debit and credit. All right, so whenever you see a T account, it's just representing the ledger account for whatever account we're talking about. And then when you, there's another one, prepaid insurance. When you get all done, then before we do our adjusting entries, then we do a trial balance where you list every account that you have in your bookkeeping system, and you check the debits and the credits. So they're all listed in order. Your assets first, so cash, accounts receivable, equipment, furniture. Then your liabilities, accounts payable. Then your owner's equity, the capital and the drawing. Then your revenues. Then your expenses. So you list all the accounts and their ledger balance, and then you check to make sure debits equal credits. And you would do that before you would do any adjusting entries, before you do any closing entries, before you would close your books at the end of any period. All right, so that's the end of just a quick introduction, which is basically the accounting cycle in the first 4 chapters of financial accounting in, I don't know, what do we spend, 10, 15 minutes. So now we turn to chapter 13, And the first thing to point out is that liabilities are debt financing. So when we looked at assets equals liabilities plus owner's equity, liabilities are the fact that we're using other people's money to fund our assets. So if you think about your equation, again, assets equals liabilities plus equity. The liabilities are using other people's money to pay for our assets, as opposed to equity financing. That's where we're selling common stock or preferred stock, or we're just earning the money, retained earnings, to pay for our assets. Liabilities then are future sacrifices. They come in different categories. So future sacrifices such as warranties. So for instance, your cell phone, the only way you'll get somebody to buy a cell phone, because it has so many parts to it and could break down, is that you offer a 2-year warranty. So for 2 years, you have a liability that if anything goes wrong, that you're going to fix or replace it. Liabilities are also present obligations, such as payroll. So your workers work for you. You have that legal obligation to pay your employees for the work they perform. And then also the past obligations. So for example, a mortgage, that you have signed a contract that you're going to buy a building, and therefore you're going to make mortgage payments. So liabilities come under future, present, and past. When we talk about current liabilities, then current liabilities are liabilities that we're going to pay within 1 year or one accounting cycle. We don't deal with the one accounting cycle. The classic is cigarettes take 2.5 years from the time you plant the plant in the ground until you have a finished cigarette. So we're not going to deal with that. We're just going to have current liabilities. We'll deal with 1 year. And in the absence in your homework of being told anything different, we'll use a calendar year. Accounts payable then are bills that you're going to pay within 1 year. It's also called trades payable. And these are recorded at the face amount that you owe. And then we also have short-term notes payable. And notes payable are different than accounts payable. They're just more formalized. So you're going to take out a 90-day note from a bank. That's going to have supporting documentation, paperwork, where you go in and sign papers. Whereas accounts payable is if you're going to sell to somebody, you're going to, run a credit check on them, decide whether or not you are going to sell to them. You're going to give them a credit amount, and then you're going to sell to them. They're going to owe you money. So their accounts payable is your accounts receivable, and vice versa. When you buy from somebody, your accounts payable is their accounts receivable. So that's just an agreement that you're going to pay. They'll give you terms of something like 210 net 30. So that just means you're going to pay within 30 days. The net amount is due within 30 days. When you go into notes payable, the short-term notes payable, then that's more formalized, and you're going to pay them within a year. So short-term means within a year. Credit lines then are a legal right to borrow money that you'll go to a bank, and so that you can support your needs, so you can support your cash flow, you'll go to a bank ahead of time and say, I would like to set up a credit limit with you. And so you might say $50,000. So they'll set up a credit line ahead of time so that in the future, if you need money, you've got that guarantee that you can just write a check and deposit that money into your account. They have to honor that. So they can't turn around later and say, just kidding, we're not going to loan you that money. So that gives you that guarantee that you'll have that cash flow. So it's a credit line is just a bank loan, but it's done ahead of time to guarantee that as you run your business cycles, that you know that you can get that loan and have that money and just go to the bank and drop that money into your account. And the way that you're going to calculate interest when you do borrow the money is what you learned in high school, is principal times rate times time. And everything needs to be done. Interest rates are calculated on an annual basis. So if they say it's a 12% interest rate, that's an annual rate. So then your time also needs to be on an annual rate. So if you take out a 90-day loan, that'll be 90 over 365, because you have to match that up with the annual interest rate. Then if you're going to work with days, then a 90-day loan would be 90 over 365. All right, so let me stop there for just a second. All right, continuing on with Chapter 13, we're going to do trade loans, and this would be if you go to a business and buy a piece of equipment, and they say, if you buy from us, we'll finance you. So they give you a great interest rate. So instead of you going to a bank, they finance you. So that's called a trade loan. And with that trade loan, then the interest is not in the face. So what you're going to record on your books is you're going to record the store equipment that you purchased and that you owe the company that you bought from a notes payable. And again, remember, notes payable is different than accounts payable because it's more formal. It's more formalized. Then when you go back and pay that note off, so you take out this note the 18th of May, and so it's a 90-day note, then you're going to take the notes payable. It's a credit when you put it on the books. It's a debit when you take it off the books. So you're going to debit the $4,000. You're going to have $80 in interest, which would be principal times rate times time. And then the cash that you pay is going to be the principal of the $4,000 plus the interest. And again, the interest was principal times rate times time. So when the interest is not in the face, it's at the point that you make the payment that you record the interest expense. If you go borrow the money from the bank, then the bank will take the money out as soon as they loan you the money. So you will record the notes payable and the cash, but the bank immediately takes the they don't give you the whole 10,000. They immediately take the interest out. So even though you're borrowing 10,000, you're not getting 10,000 in cash. So how do you handle that? You write off the $100 in this second example, whatever the numbers were from this textbook. The interest expense was calculated at $100. You immediately record that as interest expense, and then when you go to record the payment, then it's just a debit to notes payable to take the notes payable off the books. It went on the books as a credit. Now you take it off the books and you make the payment of cash as a credit, so a decrease in your cash account. So the difference between the two, the interest expense is recorded when you make the payment, when the interest is not in the face. Here, when the interest is in the face, in other words, non-interest bearing, then the interest expense is recorded immediately. Right? So this is one way of doing this. Your textbook does it slightly different. So what they do is that, well, let's just read through the example. On May 1st, Affiliated Technology, a consumer electronics firm, borrows $700,000 cash from Bank Corp with a 6-month non-interest bearing note with a 12% discount rate. Interest was payable at maturity. So what they're going to record is the notes payable at $700,000. The interest is calculated at principal times rate times time. So the $700,000 principal, 12%, and then it's calculated at a monthly rate, so 6/12, right? It's up here. They told you it was a 6-month, right, instead of 180-day. So that was your clue to use months, right? So it's $42,000. They put that into a contra notes payable account. So it's discount on notes payable. And so the cash proceeds, or the money you receive, is the $658. Then, when you pay for this, what you'll do is you'll convert that discount into interest expense when the 90 days is up, and then you'll pay off the notes payable. Does that make sense? So the discount ultimately becomes the interest expense, but not until time goes by. And then the notes payable comes off the books because you're going to pay it. So then your cash goes down. So the question is then, what's the effective interest rate? Because the interest up here, if we go back up, was calculated at 12%, but that's not the effective interest rate because the cash that you actually received was $658. So to figure out what the effective interest rate is, you would take the $42,000 interest, what the interest expense is, divided by the $658, and you'd see that that is 6.38. But that's for 6 months. So you would have to multiply that times 2 to get the annual interest rate. Right? So you'd have to multiply it times 2. That makes sense? So then you get a little question here asking you that. So just as a practice question, they say, what is the effective interest rate on a 1-year non-interest bearing note with a stated rate of 10% and a maturity value of 100,000. So you'd have to figure out what the interest is, which would be principal times rate times time. And then you'd subtract the interest rate to see what cash you would get, right? So let's just cheat and look at the answer, right? The principal times the rate, that's 10,000, right? And then you take the interest divided by the cash received, which would be the 100,000 minus the interest. And that would be 10,000 over 90,000. So the effective interest rate in this example here would be C, 11.11%. All right? Let's skip commercial paper here. On May 1st, they borrowed $700,000 from Bank Corp under a non-committed short-term credit line and issued a 6-month. Interest was payable at maturity, but assume this time that the fiscal year ends on June 30th, 2 months after the 6-month note is issued. So they're going to issue the note, right? Cash and notes payable. And then what you have to do, and what they're trying to point out here, is that 2 months later, because of the matching principle, you have to take and record interest expense and interest payable. The matching principle says revenue and expenses have to be recorded in the time period that they occur. So what you have to do is take the principal times the rate, and 2 months out of 12 months has gone by. So since you have borrowed that money, you have an obligation to pay that interest. It's just not time to pay it yet. So therefore, you do have an interest expense, but it's not time to pay it. So you're going to put that into interest payable, right? Then later, when it is time to pay that note, then you're going to record on the payment on November 1st, you have 4 more months have now gone by, so you need to get interest expense for 4 more months. You have to take the interest payable that you put on the books up here, you got to take that off the books because you are now paying it. You have to take the original notes payable of $700,000 off the books, and then you have to pay cash of the $700,000 you borrowed plus the 6 months worth of interest. So the $28,000 represents 4 months worth of interest. The $14,000 represents 2 months worth of interest. But you have to put this in 2 pieces because this first 2 months was in one fiscal year. This other interest expense was in another fiscal year. And because of the matching principle, you have to put the expense in the proper time period. All right. Vacation pay is next. Let's see if this makes sense. Vacation pay is a liability because what you're doing is saying that people work in the current period, but in the future, they're going to take off work and go on vacation, and then you're going to give them a paycheck. So you have a liability to give them money sometime in the future. So Getty Company has 8,000 employees. Each employee earns 2 weeks of paid vacation per year. Vacation pay not taken in the year earned can be carried over to subsequent years. So during 2016, 2,500 employees took both week vacation, but at the end of the year, 5,500 employees had taken carryover time as follows. So 2,500 vacation earned but not taken was 0, so they had no carryover. 2,000 employees had taken 1 week, right? And 3,500 hadn't taken any vacation, so they had both of their weeks still that they could take in the future. So 2,500 employees had used up both of their 2 weeks paid vacation, so there was no carryover. 2,000 used 1 week, so they still had 1 week coming. 3,500 employees still didn't use any vacation, so they had both weeks still to come. So in other words, there were 7,000 weeks of paid vacation to come. Does that make sense? So that's a total of 9,000. And the average compensation was $600 a week per employee. So what you would have to make is you would have to make an adjusting entry on December 31st to show the potential liability of salary and wage expense of $5,400,000 in wage expense, and then the liability of $5,400,000. Right? So you had 2,500 times 2 weeks times 600 plus 2,000 employees at 1 week at 600 is 4,200,000. That's the vacation that was actually taken. So that goes up here. The 9,000 carryover, the second number, this, see this red arrow here? That's the adjusting entry. That's the potential liability. So you record the expense, this top one is recording the expense of the wages, the vacation that were taken. The second journal entry is the vacation pay that was not taken, right? So again, this is the calculation here. 2,000 weeks and 7,000 weeks, so a total of 9,000 weeks at $600 average pay per employee. So 9,000 carryover weeks at $600 per week. They have a liability of $5,400,000 that sometime in the future those employees are going to take that. Then in the next year, when the employees did take their vacation, the actual cash that they had to pay out was $5,700,000. The liability was $5,400,000, but remember that $600,000 was a guess. So you take the liability off the books, that cash was the actual amount, but you're short. You're short how much cash that you need to actually pay for the people that took their vacation. So you have an additional $300,000 in salary and wage expense that has to go into the current period because your guess was off. That's $600 per employee average. That guess was not enough, but you don't know that. So where does that expense go? It just has to go in the current year because you can't do anything about it. So when those vacation, the next year, when people actually take their vacation, you estimated $5,400,000. So you take that $5,400,000 off the books. When you actually calculate how much you owe those people, it's $5,700,000. So based on what their actual wage rate is, so you have to cough up another $300,000. That becomes a wage expense in the current period. All right, let's move on. Deposits. All right. Deposits, you take a deposit from somebody, you get the money, and you're going to have to give them back the money, right? So that's a liability that you're going to owe them the money. So let's look at this example. Rancor Chemical Company sells combustible chemicals in reusable containers. So they charge a deposit. So the containers delivered during the year were $300,000. Deposits are forfeited if the containers are not returned within 1 year. 90% of the containers are returned within the allotted time. The deposits charged are twice the actual cost of the containers, right? The inventory of the containers remains on the company's books until the deposits are forfeited, right? So when the deposits are collected, they collected, right, $300,000. So they get the cash, but they have the liability that when people bring back the containers, they have that liability. They have to give that money back. 90% in the second journal entry, 90% of the people returned the containers. So the liability comes off the books and they give people the cash back. Right? So they take in the cash of $300,000, they give back the cash of $270,000. So they still have $30,000 in cash. Right? Now the problem with that is after a year's time, the people that don't return the drums then can't, think of this like kegs of beer, they can't return the drums after a year, then what you have to do is record that as revenue. So that $30,000 extra cash, you have to record as revenue and then take the liability off the books. But at the same time that you record that revenue and take the liability off the books, remember up here it said that the containers were carried as inventory on the books, right? The inventory of containers remains on the books until the deposits are forfeited. They're saying that they still own those containers until it's declared that they're forfeited. So at that point in time that they declare that those containers are never going to come back, they record the revenue of $30,000, they take the liability off the books. Now they record that they have to record that they no longer have the inventory, which was 50% of what they charged. So they take the inventory off the books with a credit, and they now have the expense. So they're going to record the revenue of $30,000 and the cost of goods sold of $15,000. So they're going to make a $15,000 profit on people not returning those containers. Just walk through it again and give it a chance to sink in that those containers that were forfeited, they make a revenue out of it, right? So they take the liability off the books, but at the same point in time that they record the revenue, they record the expense, because now they're saying that they're gone forever, so we're no longer going to carry them in our inventory. So they're now going to declare them sold to the customer that never returned them. So at that point in time, they're saying, okay, if you didn't return them within a year, you the customer, have now bought those containers. So this is the same exact transaction as if for perpetual inventory. You're going to take them out of inventory, do the cost of goods sold, and then record the revenue. All right. Then the next one is unearned revenue, or advances from customers. And this would be, for example, magazine subscriptions. So subscription revenue is recognized over the term of the subscription. So this company tomorrow collects $20 million in subscription sales during its first year of operation, and the average subscription 1/4 had expired. So what they collected was cash of 20 million, right? This is in million, and they have deferred revenue. That deferred revenue is a liability. It's not revenue. Deferred revenue is a liability account. Then 1/4 has expired, right? They've sent out the magazines. So at that point, they take it out of the liability account and make it revenue. So here it's an asset and a liability. Here it's a reduction of a liability and an increase to the revenue account. Did I go too fast? I hope that makes sense. Gift cards, same thing, right? You're getting money ahead of time, right? You have not done any work for this. So when you sell a gift card, you're getting the cash, but you have not performed a service. So they sold 2 million in gift cards, right? Also during May, 1.5 million gift cards sold in May and in prior periods were redeemed by customer, and 1 million of gift cards sold in prior periods expired unused. So let's see if this makes sense. They sell gift cards of 2 million, so they get cash, and the 2 million goes into deferred revenue. And again, don't forget, deferred revenue just means a liability. Then people redeem the gift cards, so they come to your place and use the gift cards, you now take it out of the liability account and record it as revenue. But when people then don't use the gift cards and the gift cards expire, you put on the gift card has to be used within 1 year, then the dollar value of the gift cards that expires, now you take that liability off the books and you record that as revenue. And you have to pay taxes on that. In California, when I moved out from Illinois, the students informed me that it's a California law that gift certificates, gift cards, never expire. In Illinois, we put a date on them, and you've got 1 year from the date it's sold to use them. After 1 year, you don't have to honor the gift cards, right? So this is kind of it in a nutshell. When you sell the gift cards, you get the cash, but this is not revenue. It's a liability. Because technically, if you don't use the gift cards, you could go back to whoever sold you the gift card, say, we're moving out of state, we just want to cash it in. They would have to give you back your money. They're not going to, but they would have to give you back your money. So it's a liability. When somebody redeems their gift card, in other words, they come to your establishment, buy their dinner, and hand you the gift card, then you convert the gift card into revenue. So you reduce the liability, increase the revenue. Right? And same thing happens then when the gift cards expire. The liability goes down and the revenue goes up. Right, in this next section, the rule is that the current portion of long-term debt, when it comes due, you have to move it from the long-term section to the short-term. So if you have bonds payable and you have a 10-year bond, at the end of the 9th year, you have to move that bond from long-term to short-term. So you have to reclassify the long-term to the short-term. Well, what happens is that businesses will go out and reissue bonds, and they're going to issue new bonds to pay off the old bonds. So they can just roll this over. So let's just look at this example and see if this makes sense. Brown Brothers Ice Cream had 12 million of notes that mature in 2017 and had 4 million of bonds that were issued back in 87 that are going to mature in 2017. So on December of 2016, at the end of the company's fiscal year end, they decided that they're going to refinance both on a long-term basis. So in early February, the company issues $4 million in new bonds, applying the proceeds to the bond issue that matured that month. And in early March, prior to the actual issue of the financial statements, negotiated line of credit with a commercial bank of up to $7 million that they could borrow at any time during 2017. Any borrowing will mature 2 years from the borrowing date, which means now they don't have to record it as short term for in the current year. So that $4 million in bonds, right? The $4 million of the long-term bonds, where was that? This $4 million bonds up here is just going to be replaced with the $4 million bonds. So that's going to be swapped out. Then they're going to take a $12 million notes payable that they owe back up here that they took out in 1987, but they have a $7 million line of credit, right? They're going to take out this note payable. So that $7 million is going to replace 7 out of this $12 million. So what they're actually going to show now on their classified balance sheet is, instead of putting $12 million in this current liability, this short-term liabilities, $12 million, they're going to show $5 million because they renegotiated that line of credit. So now that $7 million will replace, right, the $12 million minus the 7. So now only $5 million will be of that notes payable, right? This $12 million's coming due. Now only $5 million out of that 12 will be current. This $7 million will now be bumped up to long term, and the $4 million that should have been recorded as short term was replaced because they just issued a brand new bond. So the new bond just replaced the old bond, so now they don't have to show it as short term. Okay. So I tried to kind of write that out here. I don't know if this will make sense, but you can give it a shot. All right, loss contingencies have to be probable and estimatable, or estimable. And the deal with this is, what do you do if you're going to have a loss? Do you have to disclose it? Do you actually make a journal entry? Or do you just ignore it? So you have a factory that burns down. What do you do with it? Or how about you sell baby food, and your customers open up the baby food and there's ground up broken glass inside the baby food. Is it probable and estimatable that you're going to have a lawsuit? So you say, is it probable, reasonably possible, or a remote chance that you're going to get sued? Right? Right? Probable. And is it estimable, not estimable, or do you actually know you're going to get sued? So you follow this table, all right? And if it's known and it's probable, you know you're going to get sued, and it's in all likelihood it's probable, then you make a journal entry of the dollar value, right, of what it is, and you're going to put that expense and the liability on the books, and you're going to put it into your financial statements, right? If it falls into the next category, you would not make the journal entry, any of these disclosures. You would not make the journal entry, but what you would do is put it into the notes to the financial statements. That's the full disclosure principle. And if it's not probable and not estimable, then you do nothing. You don't even bring it up. So if you can't put a dollar value on it, and there's no way of knowing, because it's never happened, on whether or not you get sued, so it's not probable. Your lawyers say, we just don't think you're going to get sued on this, and even if you did, we couldn't even put a dollar value on it. You wouldn't do anything. That's just the way it works. Product warranty. Product warranty is when you like your cell phones. You buy a cell phone and there's so many parts to it and things that could go wrong that there's just no way you're going to buy it as is. You're not going to buy a $1,000 iPhone and not have a guarantee that it's going to last for 2 years or 5 years or whatever the guarantee is on it. So to a company that sells you the phone, they have to give you a warranty for you to buy it. So in this example, they estimate that 3% of the sales during the first 12 months of the sale and 4% for the next 12 months, right? So they make a calculation, estimates based on the industry experience indicate warranty costs of 3% of sales during the first 12 months following the sale and 4% the next 12 months. During the December 2016, its first month of availability, Caldor sold $2 million of chairs. So the cash they sold was $2 million and their revenue was $2 million, right? So that was their journal entry. What you have to do is put on the books at the same time, because of the matching principle, your revenue and expense has to go into the same time period that they occur. So an adjusting entry on December 31st of the same year of the sale, then you have to estimate how much is going to be returned. So you put that in as a debit to warranty expense and an estimated liability. So 7% of $2 million is $140,000. What you would do then when somebody brings, like your cell phone, when somebody brings it back, then you would debit the liability when somebody brings you back the product, and then you would credit, either you give them their cash back or you would credit inventory. If, for instance, if you gave somebody a cell phone and you just say, here's the new one to replace it, or Well, that's good enough. That's two examples. But you're going to take the liability off the books and either give them their cash back, or you're going to give them a new one out of inventory. Yeah, that's good. All right. Another way of doing this is to use little statistics and do expected cash flows for warranties. So instead of just using 3% and 4%, so 7% times 2 million, then you could go back into your stats class and say there's a 20% chance it's going to be 50,000, and a 50% chance it's going to be 60, and a 30% chance it's 70, and total that up and it's going to be 61 in 2017, and in 2018 it's going to be 81,000, and then you would figure out your present value of those cash flows of your warranty liability, right? So look at your present value factors, which we haven't really talked about yet. So hopefully you remember that from financial accounting. And then you'd make your calculation and you'd put on your product warranty liability. So you debit the warranty expense and credit the liability for 131,564 based on these expected cash flows, but you'd use the time value of money calculation to calculate what that number would be. And I'm just not going to worry about this subsequent events. I'll just let you read that because this video is getting really long. I clicked on that hyperlink, and if you go down to the bottom, this is a handout from a different class. I just want to spend maybe 5 minutes on this because this is a whole 16-week course. Let's see if I can blow this up. Oh my gosh, how much do I tell you with all this? Oh my gosh. All right, you've had this. All right. The payroll is probably easily divided into two parts. There's the employer taxes and the employee taxes, which is why I put a dollar bill here. And the first thing with an employee taxes is you go to the tables. Where's my tables? Yeah, here. And you have to take out the federal withholding taxes. So you'll look on how many people they declare. Are you married? Yourself, you and your wife, you, your wife and a kid, you, your wife and 2 kids, you, your wife, 2 kids, and your mother lives with you. You know, how much money did you make? And you go look up and you pull out the dollar amount of federal taxes that you're going to pay. So you get your federal withholding. To know how much, to know how many people you're withholding, to know whether that number is 1, 2, 3, 4, 5, then when an employee starts work, they fill out a W-4. So right here on line 6, they'll declare, or line 5, excuse me, they'll declare how many people they want you to hold. And up here on line 3, they'll declare whether they're single, married, but they're filing I don't know, whatever it is. So when you go sign up, you'll fill out your W-4 form, and you'll fill out your I-9 that you're legally registered, that you're a legal citizen. You're also going to pay your FICA taxes, and that's OASDI, so Old Age and Survivors Disability Insurance, which changes, the percentage changes. So in this example, it was 6.2%, and this was back in 2014. So that's your Medicare and Medicaid. So that's your FICA taxes is your Medicare and Medicaid. Oh, there's just too much to try and tell you here. It was never meant to be a pension, but it was back with Roosevelt, and people had no earnings, and people were starving to death, and so they put into the federal government this mandatory that employers would take this money out. So it's basically like 7.5%, 8%, whatever it is, of your paycheck, and it comes out of the employer's paycheck, and then out of the employee's paycheck, and then the employer has to match it. Part of that then is Medicare. So it's not only the your Social Security, but then your Medicare. So it's the two taxes together. But they all have floors and ceilings to them, so you only pay up to a certain level. So it gets really involved, and it's too much, and it makes a difference whether you're a salary employee, whether you're an hourly employee. There's all kinds of exemptions that if you're salary, do you have to pay overtime? And the answer is it depends, because if you are a firefighter or an EMT or something like that, then yes, you have to pay overtime. Well, then it depends on what your pay period is, and it makes a difference whether you're paid monthly, bi-monthly, bi-weekly, or weekly, and then how many hours are in a week, because for some people there's 45 hours in a week, some are 42 hours a week, some are 40 hours a week, some people are 37.5 hours a week. So at Cabrillo, where I teach, there's a whole 16-week class just in making all of these calculations. So there's just no way we're going to cover this here in 5 minutes. So the issue for this class is that you're going to record for the employee side, you're going to record salary and wage expense, and then all of these payables. So you're going to have FICA, which is the OASDI payable, and the FICA Medicare payable, and income tax payable, and maybe a health insurance payable, and maybe something like United Way payable, and then salary and wages payable. So this salary and wage expense, that's the gross pay. And the salary and wages payable, then that's your net pay. So all these credits here are your payables. Those are your short-term payables. And then what you'll do is all these payables have to be sent in at a specific time. And then that gets complicated because it depends on how much money you're talking about, it depends on how many employees, and some of them have to be sent in once a year, sometimes once every 3 months, sometimes once every month. Some of them have to be sent in by the next day. I mean, so it gets really nutso. Then the employer taxes, employer taxes, sorry, I had to stop and think there for a second. Then the employer has to match the FICA, so the OASDI and the Medicare, but they also have the FUTA and SUTA, so the federal unemployment and the state unemployment. But the expense there is called payroll tax expense. So up here it was wage expense, wage or wage and salary expense, salary and wage expense. Here it's payroll tax expense, and then all the payables. So again, this gets super complicated, so just go by what's in your textbook and don't try and make it a 16-week course. I think I'm going to leave it at that because I just don't think we want to go a whole lot deeper. Alright? I know this video is ungodly boring, but I'm not sure how else to get you all of this information. You can give me feedback. I wish I had known that we were going to go through and make these videos, or that I was going to need these videos, because I could have spent more time making them and put more call outs like I'm doing did at the beginning of the video, but this is terribly time consuming. So I will try and get started on next week's video now and see if I can't add more arrows and animations and ghosting and other such things to make them better quality for you. All right, that's as much as I'm going to do. Thanks.